Now we've looked at the concept of audit risk, and we now know that audit risk is a risk that we as auditors, we sign off on. We give a clean, unqualified opinion on materially misstated financials. Now we talked about materiality here. And as I told you, if audit risk was high, we lowered the level of materiality. So let's say if internal controls were not so good, what happened? Control risk increased. Risk of material misstatement increased. So RMM was inherent risk into control risk. So if CR increases, RMM increases. Then we needed to have a lower level of detection risk. What did we have to do? We had to do more substantive testing. So guys, that is what is happening here, right? So if control risk increases or RMM increases, that's increase in audit risk. We decreased the level of materiality. We did more substantive testing, more audit work. So that was about materiality. Now I told you, we are on the lookout for material misstatements. Let's now talk about misstatements. Now, a misstatement could be an omission. So let us say the client omitted to record certain material transactions. That's a material misstatement. They omitted an account balance. Again, that's a misstatement. It could be a deviation. So instead of recording the right dollar numbers, they recorded wrong dollar numbers. That's a misstatement. If it's material, it's important to us. It could also be a failure to disclose. Now, we know that there are a lot of required disclosures on these financials. Now, if they have missed out a material disclosure, that's a material misstatement. Now, misstatement could be due to errors. Now, this is a mistake, an oversight. It's unintentional. Misstatements can also happen due to fraud. This is intentional. So let's say the management is lying. They're lying about the numbers that you have on the financials here. They've cooked up the books. Fraudulent financial reporting. So lying is a fraudulent financial reporting. This is what we call management fraud. Another kind of fraud, stealing. Let's say the controller is taking home the company's cash. They're misappropriating the company assets. That's fraud. Fraud can also happen by cheating, illegal acts. Let's say the company is evading taxes, they're not paying the taxes on time. That's cheating, that's an illegal act. Let's say they are not following certain occupational safety norms that has been imposed by regulation. That's again cheating, that's an illegal act. Now, mostly illegal acts, they are intentional. There could be certain illegal acts which happen unintentionally, but generally we'll study it as part of fraud. Now guys, as auditors, when we come in, we are on the lookout for material misstatements, whether due to error or fraud. Now, material misstatements due to fraud, they could end up being very difficult to detect, because if you realize it's done intentionally, there's a lot of concealment, collusion by the management there, and we have to be very careful in trying to find out. Now, I'll give you a particular triangle which will help us in analyzing whether fraud exists. So I'll give you a fraud risk triangle. So you have certain fraud risk factors. The first fraud risk factor is incentive or pressure. So why do you think management is going to cook up these books? Because if profit is high, if income is high, they're going to get more bonuses. There's a lot of incentive that they have. How about pressure from the shareholders? So let's say the CEO was given a target this year by the board, and he was told that you need to show $10 million of profits in the books. and at the end of the year he could do just 3. There's a lot of pressure on him to convert that $3 million to $10 million. So that is a fraud risk factor. It's a factor which may cause fraud. Now, only incentive pressure won't help. There needs to be an opportunity to do the fraud. So there's a lot of incentive that the CEO has if the profit is higher. There's a lot of pressure he's got from shareholders. He has an opportunity. He can override internal controls. The entire finance team, the CFO, they'll do exactly as the CEO tells them. So guys, not only does he have incentive pressure, he's got an opportunity which increases the risk of fraud. Now, let's talk about stealing. So they'll say the controller wants to take home the company's cash. He's got incentive, right? He'll get cash, dollars in his pocket. He might have a lot of pressure from his house. Yeah, that's possible. So incentive or pressure. Opportunity, he's taking care of all the cash. He can manipulate on the internal controls. He can take home without people realizing that he's stealing. So he's got incentive, he's got an opportunity. Now, the third factor which completes this fraud risk triangle is rationalization. This is about moral values, about ethics and integrity. This is something that you learned in your moral science lessons in school. So again, let's go with both examples. First example on lying. We had our CEO who just made 3 million this year, has to show 10 million. He's got incentive, he's got pressure. He has an opportunity. He can simply override all internal controls. But let's say he is a man of ethics, a man of principles, man of values. He says, I'm better off being fired rather than converting the 3 million of profits to 10 million. He is not able to justify, rationalize the fraud. Will fraud happen? Will the books end up being cooked up? No. So guys, for fraud to happen, all these 3 factors generally need to exist. Let's talk about a controller who's taking away the company's cash. He's got incentive, he's got pressure from home. He's got an opportunity, he's looking after cash, he can override the internal controls there. And let's say he says the company is making millions of dollars of profit and they're paying me only a few $1,000s. How about I take some cash home? So he's able to rationalize. He is not an ethical man. That's why fraud happens. That's why he's able to steal from the company. He's able to misappropriate company assets. We call it theft. You can call it embezzlement. You can call it a defalcation scheme. Remember these terms. You often have it on multiple choice questions. Now guys, as I told you, when we step into the company as auditors, it's very important for us to look out for fraud because we want to give a reasonable assurance that these financial statements are free from any material misstatements, whether due to error or fraud. So when we step into the company, we got to be really, really careful for fraud. We need to keep our eyes, our ears, everything open, and we need to be very careful.
Let's get on to page 21, where we're looking at fraud risk. Let's do a little recap on this page. Right there, misstatements, they could be due to errors which are unintentional or fraud which is intentional. Misstatements, whether due to error or fraud. Errors, they are unintentional. Fraud, that's an intentional act. And when we're looking at fraud, our question is it lying, right? Stealing, or is it cheating? Cheating, that's illegal acts. So once again, material misstatements in the financials can result from highlight errors which are unintentional mistakes or highlight fraud which is an intentional act. Under fraud, it could be highlight fraudulent financial reporting, that's a management fraud, and right there, lying, or it could be highlight misappropriation of assets or defalcation or an embezzlement scheme, and right there, stealing. On the second bullet, highlight illegal acts. And right there, cheating or corruption. Now, we're going to be talking about auditors' responsibilities regarding illegal acts in Refer Audit 4.6, the second subtopic there. Now, basically, the auditor's responsibilities regarding illegal acts can be categorized as number one, highlight laws and regulations generally recognized to have a direct effect on the financials. And in such cases, it is underlying the auditor's responsibility to obtain sufficient, appropriate audit evidence. For example, if the management is evading taxes. Now, taxes have a direct effect on the financials. So the auditor's responsibility here is to obtain sufficient appropriate audit evidence regarding taxes or the tax evasion by the management. However, there are highlight other laws and regulations that do not have a direct effect on the financials. For example, laws and regulations which relate to occupational safety and health, or which relate to equal employment opportunity, or which relate to environmental regulations. Now, these laws and regulations do not have a direct effect on the financials, and it might be difficult for the auditor to find out about these. In this case, underline the auditor's responsibility is limited to performing specified audit procedures, to identify, underline non-compliance that may have a material effect on the financials. Note that the auditor may generally not become aware of the non-compliance unless there is evidence of in records, documents, or other information normally inspected in a financial statement audit. Turn on to page 22. We'll be looking at highlight fraud risk factors. And here we're going to talk about the fraud risk triangle. So the first one is incentives or pressure. And you might want to make a note there. This is about reason to commit fraud. Is it personal gain? Or it could be pressure from stakeholders. Next one is opportunities to commit fraud. And right there, it could be due to bad internal control or override of internal controls. And the third one in this fraud risk triangle is rationalization. And right there, lack of ethics and integrity. So guys, putting a fraud risk triangle together, we have incentives or pressure. Second one, opportunities. And the third one is rationalization, which is a lack of ethics and integrity. Generally, when you have all these three come together, that's when you see fraud happening. Now, let's go down towards the bottom of the page and make a little note out there. Right there, management responsibility is to implement internal controls to prevent, detect, and deter fraud. it's the management responsibility to take care of things that's happening at the entity. Right? Auditor only provides reasonable assurance. But there's a catch here, right? Note, fraud is generally difficult to detect due to concealments and collusions. So the auditor is only providing a reasonable assurance that the financial statements have no material misstatements, whether due to error or fraud. Generally, for auditors, it's difficult to detect fraud because there could be concealments, there could be collusions whenever there is fraud. Turn to page 23 and highlight auditor's responsibility for the consideration of fraud in a financial statement audit. Now, very important, highlight professional skepticism to be maintained throughout the audit. Basically, the auditor needs to come in with a professionally skeptic attitude. The auditor needs to recognize a possibility of fraud, irrespective of the auditor's past experience of honesty or integrity of the management or those charged with governance. Now, due to the inherent limitations of an audit, an unavoidable risk exists that some material misstatements of the financials may not be detected. Now, the potential effects of inherent limitations are particularly significant in case of fraud risk. Highlight risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. Because with frauds, you often have underlying concealment and underlying collusion. Next, highlight risk of the auditor not detecting a material misstatement resulting from management fraud is greater than for employee fraud. Since management, they're frequently in a position to directly or indirectly manipulate accounting records, present fraudulent financial information, or override internal controls designed to prevent similar frauds by other employees. And remember, the auditor's consideration of fraud in a financial statement audit, I'm going to be giving you another mnemonic. So all you future CPAs out there, all you future auditors, remember, as far as fraud is concerned, you're supposed to be drilling into any kind of recklessness by the management. So your mnemonic for consideration of fraud is drill into any recklessness. So fill in the bubbles there. DRILL and REC of recklessness. So the D of drill, highlight discussion. So you discuss fraud risk with the engagement team. The R of drill is highlight risk assessment procedures. I is highlight identify and assess fraud risks. The first L, highlight risk of fraud in revenue recognition and write there line number 1. The second L, highlight risks related to management override of internal controls and write there line number 2. So guys, these two lies, line number 1 and line number 2, are risks which you as auditors are supposed to presume in every audit. So that's the drill. The R of recklessness highlight responses to assessed fraud risks. E is highlight evaluation of audit evidence. And the C of recklessness, that's highlight communication about fraud. Now, where you have the examples of circumstances that indicate the possibility of fraud, put a star there and write look out for, and let's highlight all of these. So the auditor is supposed to look out for, highlight discrepancies in accounting records, conflicting or missing evidence, problematic or unusual relationships between auditor and management, unwillingness by management to permit the auditor to meet privately with those charged with governance, accounting policies that appear to be at variance with industry norms, frequent changes in accounting estimates even without change in circumstances, tolerance of violations of the entity's code of conduct. For example, somebody stole the entity's money and that employee was awarded the best employee of the year. That's like tolerance of violations of the entity's code of conduct. Now, when you as an auditor are out there and you find such circumstances, you're of course looking out for them. Whenever you find any of these circumstances, your responsibility as an auditor is to drill into any recklessness. Turn now to page 24, where we'll look into in detail the auditor's consideration of fraud. And our mnemonic here is drill into any recklessness. So on the first bubble there, write D and highlight discussion of fraud risk with the engagement team. And this includes underline brainstorming. A few lines below, highlight communication should continue throughout the audit and underline particularly upon discovery of new facts. On the next bubble, write R and highlight risk assessment procedures. Highlight the inquiries. So the auditor should make inquiries of management, those charged with governance, internal auditors, employees, legal counsel, and others within the entity, whether they have knowledge of any actual, suspected, or alleged fraud. So write there, obtain info. Now note that management is often in the best position to perpetrate fraud. Accordingly, underline when evaluating management's responses to inquiries with professional skepticism, the auditor may judge it necessary to underline corroborate responses to inquiries with other information. Highlight if responses are inconsistent or unsatisfactory, for example, vague or implausible, the auditor should investigate further. The auditor should look at highlight unusual or unexpected relationships which are identified based on put a box around analytical procedures. The auditor should also evaluate the fraud risk factors, which means he should look out for events or conditions that indicate any or all of the fraud risk factors. And as we know, the fraud risk factors, they are number 1, incentives or pressure, number 2, opportunity, and number 3, rationalization. However, underlying inability to observe any or all factors does not imply that no fraud risk exists. On the next bubble, write I, so that's the I of our drill, and highlight identify and assess fraud risks, where the auditor should consider underlying risk attributes. The auditor should look at underlying type of risk, whether it's lying or stealing. He should consider underlying magnitude, material or immaterial. Underlying likelihood of risk, whether the risk is known, it's likely or unlikely. And underlying pervasiveness of risk, whether the risk affects one assertion, one account or transaction, or the entire financial statements. Now, there are certain risks that the auditor should underline presume in every audit. And that's the two L's of our drill. So the next two bubbles, write L and L. For the first L, write lie 1. The second L, as we know, is lie number 2. So lie number 1, that the auditor should presume in every audit, is highlight the risk of fraud in revenue recognition. Lie number 2, that again the auditor should presume in every audit, is highlight risks related to management override of internal controls. Again guys, since management is in a unique position to perpetrate fraud, this one's very important. Move on to page 25. And before we read further, recall that our mnemonic for auditors' consideration of fraud is drill into any recklessness. On the previous page, if you've looked at drill, where the D of drill was discussion with engagement team, R was risk assessment procedures, I was identify and assess fraud. The two L's were line number 1 and line number 2. Now on this page, we are starting with the recklessness. So the first bubble there, write R and highlight response to assessed fraud risks. Highlight overall responses. So that's the general response. A couple of lines below, highlight evaluate whether the selection or application of accounting policies by the entity indicate fraud. And you can make a note there, right? More fraud risk if these are subjective and or complex. The auditor should also incorporate an element of unpredictability in the selection of the nature, extent, and timing of audit procedures. Now that we've looked at the auditor's overall responses, let's talk about highlight specific responses, where the auditor should design and perform further audit procedures, that's the test of controls and substantive tests, whose met or the nature, extent, and timing is responsive to the assessed fraud risk at the assertion level. For example, if the auditor identifies that management is under pressure to meet earnings expectations, there may be a related risk that management is inflating sales by entering into sales agreements that include terms that preclude revenue recognition, or by invoicing sales before delivery. In these circumstances, let's look at the auditor's sample response to lie number 1. So if you recall, lie number 1, that's the first L of drill. That's the risk of improper revenue recognition. And in response to this risk of improper revenue recognition, this risk of lying by the management, the auditor could highlight design external confirmations not only to confirm the outstanding amounts but also to confirm details of the sales agreements like date, rights of return, delivery terms, etc. The auditor could also inquire of non-financial personnel in the entity regarding any changes in sales agreements and delivery terms. Next, we have a bunch of sample response to lie number 2. So guys, lie number 2, that's the second L of our drill. And that is the risk of management override of internal controls. So in response to the risk related to management override of internal controls, the auditor could examine journal entries and adjustments to prepare financial statements. Review accounting estimates for biases and evaluate for fraud risk. And evaluate business rationale for significant unusual transactions. On the next bubble, E. So that's the E of recklessness, and evaluation of audit evidence. Put a box around analytical procedures which are performed at or near the end of the audit in forming an overall conclusion. Now, this may affect earlier assessment of fraud risk or indicate unidentified fraud risk. Please draw an arrow from analytical procedures and write required for number 1, planning, that's for initial risk assessment, and number 2 for final review. So guys, when we spoke about planning the audit, we said analytical procedures, they are mandatory as part of planning. Here we learn that analytical procedures are also mandatory as part of the final overall review. When we get to audit 4, we will also talk about analytical procedures as a part of the substantive procedures. Now, analytical procedures as a part of substantive procedures are optional. They're not mandatory. But in case of planning, that's the initial risk assessment, and in case of final review that we have here, analytical procedures are mandatory. Need to perform analytical procedures relating to revenue if that's not already performed. Now, quick examples on analytical procedures. Let's say you're looking at the entity which had revenues of, let's say, 100 million last year, and this year they have done 180 million, 80% year-on-year growth. Now, that could be a question mark. Now, what's the reasoning behind the 80% growth? Is it justified? Is there sufficient appropriate audit evidence around that 80% increase? Or let's say, in the beginning of the year, when the entity came out with a budget, they had budgeted this year's sales to be 120, but they achieved 180. So guys, we did last year versus this year. We did budget versus actual. Let's say the industry has a gross margin of 20%, but this entity has 30% gross margin. That's again a question mark. So you're doing industry versus the entity or the client. So guys, that's about analytical procedures where you use a lot of ratios. You look out for unusual relationships and try to find red flags. And guys, from a fraud risk perspective, we know that those red flags could smell of fraud. So that is where analytical procedures have an important role to play when we are looking at the evaluation of audit evidence to make sure that we didn't miss out on any of those red flags. On the next bullet, highlight consideration of identified misstatements. So, given that an instance of fraud is unlikely to be an isolated occurrence, evaluate implications to other aspects of the audit, especially evaluation of materiality, management integrity, reliability of management representations, which we'll talk about in Audit 4. Highlight if auditor believes that senior management is involved in a fraud, the auditor should reevaluate the assessment of and response to fraud risk. That's big trouble. In that case, the auditor should also consider whether circumstances or conditions indicate possible collusion involving employees, management, or third parties when considering the reliability of evidence previously obtained. Basically, everything could become a question mark if senior management is involved in a fraud. Now, in case the auditor identifies significant fraud risk, the auditor may as well withdraw. On page 26, on the bubble there, C. So that's C of recklessness, and highlight communication about fraud, which needs to happen on underlying timely basis and to an appropriate level of management and those charged with governance. So communication with highlight management, underline appropriate level, which is at least one level above. Now, auditor needs to communicate with management regarding highlight any indication of fraud, even if immaterial. Next, we're talking about communication about fraud with highlight those charged with governance. And this is required for number one, highlight fraud that results in a material misstatement to the financials. And number two, very important, fraud involving senior management. Now note, when there is a fraud involving senior management, the auditor may find it inappropriate to communicate this to management and may communicate only to those charged with governance. And then we have communication about fraud to highlight outside parties. Now note that this is ordinarily not the auditor's responsibility, as auditor is bound by confidentiality rules. However, there may be certain circumstances under which auditor may need to communicate fraud to outside parties. Let's look at a few circumstances. First one there, to comply with certain underlying legal and regulatory requirements. For example, for auditors of issuers, they need to comply with the requirements of Private Securities Litigation Reform Act of 1995. And we covered this in Audit 1.2. Now, this act requires that for all illegal acts or frauds, auditor needs to communicate to the board of directors within 1 day, and the board needs to inform the SEC within another business day. If the board does not inform the SEC, the auditor directly goes to the SEC. Now, this is only for auditors of issuers. The second circumstance that we have here is in response to underlying subpoena. So guys, this is the S of IRIS that we covered in Audit 1.1. So client information is confidential except for a few exceptions, and we had our mnemonic IRIS there. And the S of iris was subpoena from court. Another circumstance where the auditor may need to communicate fraud to an outside party is to underline a successor auditor. This is when the successor makes inquiries of the predecessor with the client's permission. And we cover this in Audit 2.1. The auditor may also need to communicate fraud to underline a funding agency or other specified agency in accordance with requirements for governmental audits. And we're going to cover this in Audit 7.3. So guys, regarding communication about fraud, we know that the auditor needs to communicate fraud to management and as required to those charged with governance. In some circumstances, the auditor may also need to communicate about fraud to outside parties. And the last point that we have on this topic is highlight documentation. So here we'll talk about documentation of the auditor's consideration of fraud. Couple of important pointers. Highlight if auditor concludes that the risk of fraud in revenue recognition is overcome, document reasons for that conclusion. So that was a lie number 1. If the auditor concludes that lie number 1 is overcome, document why. And next, highlight audit procedures to address risk of management override of internal controls. And this was lie number 2. So what procedures has the auditor performed to address the risk of lie 2? Now, before we move on, let's take a step back. Let's turn back to page number 23 and quickly recap on the auditor's consideration of fraud. And our mnemonic there is drill into any recklessness. So we've seen the D of drill, that's discussion of fraud risk with the engagement team. R is risk assessment procedures. The I of drill is to identify and assess fraud risks. Here we specially look at both the lies, lie number 1 and lie number 2. Where lie number 1 is risk of fraud in revenue recognition. Lie number 2 is risk related to management override of internal controls. The R of recklessness is response to assessed fraud risk. So guys, in the I of drill, we have identify and assess fraud risks. So the R of recklessness is about responding to those assessed risks. The E of recklessness is evaluation of audit evidence, including performance of analytical procedures. And the C of recklessness is communication about fraud to management, to those charged with governance, and even to outside parties as required. Turn a few pages and get to page number 27. And here we are looking at examples of fraud risk factors. And on this page, we're looking at fraud risk factors which relate to highlight fraudulent financial reporting. And right there, lying. Put a star because these are very good examples often tested on your CPA exams. And of course, you remember the fraud risk triangle. So you got incentives and pressure, opportunities, and the third factor, attitude or rationalization. Turn a few pages and get to page number 27. And here we are looking at examples of fraud risk factors. And on this page, we're looking at fraud risk factors which relate to highlight fraudulent financial reporting. And right there, lying. put a star because these are very good examples often tested on your CPA exams. And of course, you remember the fraud risk triangle. So you got incentives and pressure, opportunities, and the third factor, attitude or rationalization. Turn to page 28. We're looking at fraud risk factors which relate to highlight misappropriation of assets. Put a star there and write stealing. So guys, on these two pages, page 27 and page 28, you have amazing examples regarding the three fraud risk factors which relate to lying and stealing respectively. These are often tested on your CPA exams and I want you to review them line by line on your own. So guys, that was all about risk assessment and this section specifically about fraud risk.